We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored.
Hello everyone, welcome to my channel. Next Wednesday, June the 5th, the Bank of Canada is going to announce its decision on its policy interest rate. Now, I do not believe that Canada will experience much significant interest rate cuts like what the market wishes for. Not in June and not even for the rest of the year. In this episode, I will explain why. First of all, let's talk about the monetary policy before and after the pandemic in both Canada and the United States. In Canada, for the years before the pandemic, Bank of Canada was adjusting its interest rate according to its economic condition, but it was in general at or below 1.75%. When the pandemic hit, Bank of Canada started cutting its interest rate until it reaches a level of close to zero. In March 2022, Bank of Canada started increasing its interest rate to fight inflation, and after several rounds of such action, it is now at a level of 5%. In the United States, the Federal Reserve Bank has kept the interest rate at relatively low level after the 2008 financial crisis. Now, for the years before the pandemic, the interest rate was slowly going up until it reached 2.5%. In 2020, when the pandemic hit, however, the Federal Reserve Bank started slashing its interest rate until it reaches to a level of close to zero. And in March 2022, the Federal Reserve Bank started to raise its interest rate. And again, after several rounds, now it's at a level of 5.25%. For someone like me who has mostly lived in period where interest rate is quite low, now having to face a much higher interest rate feels a bit unusual. For example, if someone has purchased a house in the past several years, they are now facing their mortgage payments doubling up. This is quite inconvenient for a lot of the Canadians, and therefore I hear it, the Canadian market is desiring an interest rate cut as soon as possible. However, if we look at the interest rate history, you have to realize that a rate at between 4 and 5% is not that high. In fact, it's about more ordinary or average level. When the interest rate is quite low, especially when it's close to zero level, the central bank actually loses the function of the monetary tool because it needs to lower the interest rate to stimulate the economy, but the rate cannot go into negative territory. And this is called a liquidity trap, which is what Japan has experienced for many, many years. And that's what the US and Canada central banks is avoiding, and they want to keep the interest rate in a reasonable level where they have enough room to maneuver in both directions. Now, let's hear what the Canadian experts are saying. In May 2024, Tiff Macklem, the governor of Bank of Canada, indicated that the interest rate cut in June is within the range of possibility. Back in April, Andrew Wason, a senior economist of CIBC, and two Wynne economists from RSM Canada, both commented that they expect the Bank of Canada to start shifting towards more of a dovish tone, and the restrictive money cycle is now nearing end. The June cut is very likely. Let's look at the April inflation number, which is a key factor that the central bank has to look at and be comfortable with before they can cut the interest rate. In fact, all the key measures of the inflation in Canada come out to be pretty good on a year-over-year basis, and this is clear in the past for an interest rate cut in June. With that being said, does that mean that Canada is ready to embark on a new easing monetary cycle? Well, my view is maybe not yet. Why? Long story being short, the Bank of Canada has to pay attention to what their counterparty in the United States is doing. And here is what the federal officials are saying these days.
Though the funds rate was seen as restrictive overall, many were sort of uncertain about how restrictive the funds rate actually was. They discussed the possibility that the neutral rate may be higher and that higher rates may be less effective at slowing the economy than they had been in the past. They saw the lack of...
So here, what the federal officials were saying is that they were not only expressing their discontent of not being able to curb the inflation into below 2% territory, they were discussing if the current interest rate is high enough to curb inflation, that whether there is a necessity to further increase the interest rate. Now, if this is going to happen, it will put Canada in a bit of awkward position. In the scenario when the next move of the US Central Bank is to lower the interest rate for sure, that the only question is when that will happen, then the fact that the Bank of Canada moved a bit earlier than its counterparty does is something that Bank of Canada will be more comfortable with. However, if the central bank in the US started raising its interest rate again, then Bank of Canada will face a difficult situation such that on one hand, it has the economy that seems to be in recession and needs stimulation, and on the other hand, its superpower neighbor is further tightening its economy. Now, why do we care about all this? Let's go over the historical periods to see how the monetary policy has played out in the two countries. Back in 1980s, when there was high inflation, and by that we meant an inflation rate of 14.8% in the United States, Paul Volcker, the chairman of the Federal Reserve Bank at the time, decided to raise the interest rate aggressively, and in fact, he didn't stop until it reached a peak of 20%, which eventually led the US to a recession, which was called a Volcker shock. Now, Canada, on the other hand, also faced severe inflation and was forced to raise interest rate as well. The Canadian interest rate did not stop increasing until it reached a peak of 21%. So here you see that the monetary policy of the two countries are largely in line with each other, with small divergence. In 2008, when the financial crisis hit the United States, the central bank slashed its interest rate in an unprecedented way. Starting in July 2007, the US Federal Reserve cut its interest rate from 5.25% all the way down to 0.25%. Now, the Canadian Central Bank initially didn't do anything, but by the end of 2007, the Canadian Central Bank was forced to cut its interest rate as well, and it started moving from 4.5% to 0.25%. So there has been a trend in general such that the trajectory of the two countries' monetary policy are largely in line, although there was divergence such that sometime one country may move first while the other one follows in a couple months later, and the degree that they raise and cut the interest rate might be different because of the sensitivity of the interest rate to their economy, as well as their own different economic condition. That being said, you still can see the trend is the two monetary policy really go exactly opposite of each other. Has there been such a case? Yes, there was indeed such a case. Back in 2002, the US Federal Reserve rate and the Canadian policy rate were very close to each other at about 25 basis point difference. And then the US started cutting its interest rate while the Canadian Central Bank started raising its interest rate, making the gap between the two interest rates widening to as large as 225 basis points at its maximum. But this duration didn't last very long. In 2003, the Central Bank of Canada started cutting its interest rate and the US started to raise its interest rate, making the two interest rates converge. And after that, guess what? The two interest rates started moving together in the same direction. So my point is, yes, there has been periods where you see the monetary policy of the two countries go exactly opposite, but those occasions have actually been rare, short, and temporary. In fact, in the past recent years, the difference between the two countries' interest rates are around 0.75% to 1%. Now, why is that? Well, there's a couple issues here. First, there is the exchange rate. Canadian dollar is now trading at around 1.37 against US dollar, which means that the Canadian dollar is weak to begin with. If the US is going to further increase its interest rate, Canadian dollar will further weaken, which may not be very ideal for Canada. There will be a capital outflow from Canada to the United States. And also, the depreciating currency may actually bring in new inflation. Now here there is a concept of what's called pass-through rate. For an ordinary Canadian, when you go to a grocery store, you will notice how much of those goods that you are buying on a daily basis is directly imported from the United States. With a stronger US dollar, those goods will become more expensive, and that means inflation. Now with the new inflation pressure, Bank of Canada will be forced to deal with it and start raising interest rate, which is essentially following what the counterparty in the United States is doing. There was a study done by the Bank of Canada on how much the pass-through rate was for Canada in 2015. And they concluded that the pass-through rate was around between 20 and 25%, which means that for each 10% depreciation in the Canadian dollar against US dollar, they will see an increase in inflation by around 2 to 2.5%. In 2021, there was another study done on the OECD countries, including Canada, that generated a similar conclusion. So these are the reasons that I believe, given the uncertainty of the monetary policy in the United States, there is not too much room for the Bank of Canada to play around its interest rate. And I am not very optimistic of how much lower the interest rate in Canada can go at this point. If you have enjoyed my episode so far and would like more economic analysis like this in the future, please give me a thumb up and see you next time.
Comes to your role as governor, which is when are interest rates coming down? As you know, and we've discussed at this committee before, folks are struggling for a range of reasons right now. Cost of living is high, housing prices are high, but there are a lot of folks who have mortgages that are either they're on a variable rate or they're on a fixed rate, and now they've had to renew at a much higher rate, and that's been very, very difficult for a lot of folks to bear, and some have had to move out of their homes. Some have had to make significant sacrifices to make those payments. So that's the underlying reason that I'm asking this question. So I'm wondering if you could do your best to share with me, and I will share your response with my constituents. When are interest rates coming down?